Are Social Security benefit cuts a real possibility? Ooh, USA Today has an article for us all to fear. Say, oh my goodness. Pretty good article, actually. It's actually a lot more fairer than I would have thought, given that the media and the Gannett people who I think own USA Today, and in this case, from the Arizona Republic, the fear, man. Fear leads. If it bleeds, it leads in the media, and that's the way it works. But anyway, let's talk about this because I'm getting a lot of questions on this, and I even had a guy say to me, he says he doesn't even use his Social Security in his planning, which is a significant mistake. So let's go into this real quick. I'm going to do a quick run through of this article. This is now the third time I've done this video because the first time I did it had that screen, the colorful screen of death. The second time I actually deleted it, and now I'm doing this again. So we're going to run through this because I think it's pretty interesting. We have a Social Security trustees report that just came out. I was like, I didn't know that until I read this article. So that was good stuff, man. 2021 federal annual report to the Board of Trustees on Social Security. One thing I did want to point out, though, kind of creepy if you ask me. We only got 6 members, but only got 4 occupying it. And 4 is we got Marty Walsh, Big Lib, Jed Ellen, Big Lib, and Xavier Becerra, Big Lib. I don't know who this person is, but these aren't the people you want running your retirement plan. Let me just tell you like that. But be it as it may. The current projections that trust fund backing retirements will run out of money in 2033. We're going to talk about that. It's just not that big of a deal, but we'll go into it. It's also a reminder that individuals may want to do more on their own. 100%, I agree. 100% of that to prepare. All right. Anyway, so I'm going to go into this right here because this isn't the only time that we've heard this. Is a 2033 projection unusually soon? I mean, you can go back as far as your statement says, and it'll read that Social Security is projected to run out of money or to be insolvent, whatever it says, by the year 2033, 2034, 2037, 2031. Here we go. Let's check this out. In the 1997 trustees report, the depletion year was 2031. And certain other reports have been projected to come in much later, after 2050. They don't know, but it's basically, I think I'm pretty comfortable saying by the middle of next decade, we'll have not enough money to pay the bills. And that's where it's no big deal. Still, the current trend is worrisome, especially in the big baby boomer generation is retiring en masse, and there's only 2.7 workers who can now support each beneficiary. Besides, the depletion scenario is now just 12 years away. Well, this right here is stupid because, 2.7 workers now, where it used to be 16 to 1, because it wasn't paying 6.24%. Actually, it's 12.6, something like that, is what we pay for your end and your employer's end. Me, as self-employed, I pay both sides. It wasn't like that when Social Security was 16 to 1 ratio. So now it's basically a 3 to 1 ratio, but our taxes have gone more than 3 to 1. All right, so I want to share with you how Social Security works. All right, so we got accounts receivable. This is just a basic old-fashioned accounting. We got accounts payable. So we got accounts receivable of 1.2 million. We got accounts payable of $1 million. All right, so basically what this means is if you're running a business, you're saying, I got invoices outstanding that's worth 1.2 million. That's what I'll receive. That's my receipts. In fact, AR, accounts receivable, are so liquid, short-term debt, essentially, that banks will even loan you money against your accounts receivable. That's called factoring. That's how secure accounts receivable are. You're probably not, and I think when I used to do factoring, I think we'd write off about 30% of them or something like that, but we basically use 70% of the AR as money that was kind of, we'd use for collateral on the loan. So we got 1.2 million accounts receivable. AP, accounts payable, is what we got to pay out. In this case, for Social Security, accounts receivable are payroll taxes. Accounts payable is our benefits that we got to pay. So in this case, we got $200,000 surplus. All right, so we got $200,000 surplus. And that's what we're talking about here. This is a trust fund, the lockbox. All right, so the surplus is going every single year. This surplus is growing because we have 1.2 versus 1. The surplus also generates interest as well. All right, so the surplus is gaining interest also. All right, so the surplus is growing, but because the interest rates are so low, it's not gaining that much interest. So we fast forward until 2033 or 2034 or so. All right, well, actually, we'll say is not even 2034. So basically, we're gonna have $1 million of surplus. We got $800,000 of accounts receivable and $1 million of accounts payable. We'll just use this for an example. So we're running deficits from a pure cash flow, but we have a savings account basically we can tap into. So every year, because we're running deficits, we're tapping into $200,000 from the surplus in which to pay our 100% of our bills. All right, so every year, boink, 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 and boink. $200,000 goes from the surplus, all right, into the accounts payable. We don't have enough to pay the bills with just the accounts receivable, so we have to tap into our savings account. There's no other way around that. All right, so what happens at some point is that because the surplus isn't getting enough interest and not receiving enough taxes to grow, that we're dipping into principal. At some point, that surplus will be exhausted. There won't be any more money in there. And so what happens there, so these are accounts payable, these are accounts receivable. All right, hold on just a second, blink. Okay. And now we got no money in here. There's no money in the surplus. So now we're running $200,000 deficits each and every year. But notice though, we still have $800,000 coming in. We just can't pay $1 million going out. So that's the bankruptcy. That's the lack of solvency. Like any bankruptcy case, there's still money coming in to pay some of the bills. They just can't pay them all. That's it. That's it. No big deal. You think Congress is going to allow you to take a 20% decline, 20% off of your Social Security benefits? It's simply not going to happen. And again, this guy who is saying, I don't use Social Security, I'm like, that literally makes no sense to me. I mean, if you want to use 80%, I don't get that, but you can still use 80%, but not using Social Security as part of your planning, that's bad financial planning. This is your entitlement, my friends. This is not a welfare benefit. It's not. You're entitled to this because you paid for it. Now, whether or not they can make it good, name any congressman, any politician in the history of mankind, whoever said we're going to reduce your Social Security and was able to wave that flag in the halls of Washington, D.C. to get any kind of measurement passed, and even a committee. It never happened. No one's going to reduce your Social Security. It's just not going to happen. Now, will they pay or increase taxes? Yes. Like I said, increase the payroll tax by 25 basis points on both sides. If you need to increase it by 50 basis points, do it. That has skin in the game. The more skin in the game, the more of entitlement it is, as opposed to welfare benefit, the more people are most likely to take it seriously and say, I'm entitled to this, you're not taking it away. Welfare is not entitlement, it's welfare. It's like if someone gives you a car as opposed to you earning it, you take responsibility for the things you've earned. You and I have earned our Social Security benefits. Congress knows this. Just look at Dan Rostenkowski. Look up Dan Rostenkowski in Chicago, chairman of the House Ways and Means Committee back in the late 80s when they're proposing, I think, raising taxes on Social Security benefits. And watch what happened to old Dan. That's why they call Social Security the third rail of politics. You touch it, you're zapped, you're electrocuted, you're dead. Politically, no one's touching. Worst case scenario is you get 75 cents on the dollar. If you want to run that plan number, by all means. I don't, because I think it's silly. What's your justification for that? Where's your basis for evidence that's likely to happen? There is none. But if you wanted, I don't care what people do. I'm just saying when you're hiring me for financial planning, I use 100% of your Social Security benefits. That's how committed I am to the belief that it's going to pay out. I'm just not worried about it. They've been saying this for years. Look at your old Social Security statements. They've been saying the same thing. Has anyone ever lost a dime in Social Security? Well, Josh, they didn't run out of money. In 1983, they ran out of money, and they came up with a fix. Like it or hate it, they did. Some nefarious stuff there with old Reagan and Tip O'Neill and everything, but this bipartisan fix where they didn't inflate the Social Security earnings test, but they didn't inflate the tax savings and Social Security benefits either. And the USA Today in this article even says, oh, only high earners pay taxes on their Social Security benefits. Yeah, bullcrap, dude. High earners. Well, who's a high earner according to the guy from USA Today? A guy making more than $22,000 a year? It's freaking nuts. Yeah, we stop the fear. Your Social Security will be there. That does not mean you shouldn't take plan of other action. I'm just saying, when it comes to Social Security, this is nothing burger. I still say, if you're really worried, you should be worried about Medicare. We'll leave that for another time. All right, thanks. We'll love your comments. We'll see you.